Welcome to the Doubtful Investor. Today, we confront one of the market's most seductive illusions: certainty. Our focus is the spectacular implosion of long-term capital management in 1998, a story that remains a critical cautionary tale. In the labyrinth of finance, the illusion of knowing can be more dangerous than pure ignorance. Markets are not machines. They are organisms of human fear and greed. We posit a core thesis. Certainty is the single greatest vulnerability in any sophisticated portfolio. It breeds conviction, which enables leverage, which leads to fragility. The story begins in 1994 with the founding of a fund that promised to revolutionize modern investment. Long-term capital management quickly amassed an unprecedented portfolio, controlling positions well over $100 billion through aggressive leverage. The founders were financial royalty, two Nobel Prize winners in economics, Robert Merton and Myron Scholes, alongside Wall Street's top derivatives traders. This was not arrogance, it was intellectual superiority, solidified in capital. Their confidence stemmed from a single source: the belief in the efficient market hypothesis and the mathematical models they had created, which were the very basis of their Nobel recognition. But the pursuit of mathematical perfection in an imperfect system always carries an inherent flaw. LTCM's strategy was arbitrage, exploiting tiny, temporary mispricings between highly correlated bonds. They used massive leverage, up to 25-to-1, because their models assured them these gaps would close with a statistical certainty. The core of the strategy was the assumption that market behavior follows a predictable distribution, meaning historical data dictated future probability. They had calculated the odds of catastrophic loss to be astronomically small. In 1998, the unthinkable occurred. The global financial system experienced a moment the models decreed impossible. First, the Asian financial crisis, followed by the Russian default. These were black swan events, outside the historical dataset used for their risk calculations. Instead of closing, the spread between correlated assets widened violently, driven by panicked human behavior and a flight to safety. Market irrationality that defied all Nobel-winning logic. With every widening spread, LTCM faced mounting margin calls. The extreme leverage, once their advantage, became the accelerant of their own destruction. The inevitable collapse threatened not just the fund, but the entire financial system. The failure was swift. The fund lost $4.6 billion in less than 4 months. The highly complex, statistically robust portfolio evaporated in a matter of weeks. The portfolio's size posed a systemic risk. The Federal Reserve, fearing a contagion, was forced to orchestrate a $3.6 billion private sector bailout to prevent a global financial meltdown. The LTCM saga is a sobering reminder that markets operate on two axes: mathematics and psychology. No formula, however brilliant, can account for a world where people act irrationally, or where impossible events become reality. The map is not the territory. A safe portfolio is not built on certainty, but on doubt. Maintain skepticism, manage leverage, and always assume your model is imperfect. Until next time, this is the Doubtful Investor.